Credit is using tomorrow's money to pay for something you get today. Many different types of credit are available. It is important that you understand how to use credit properly so you can maximize the usefulness of credit and minimize the cost. Loans let you borrow money that must be repaid with interest. You can obtain a loan for a specific purpose, such as financing a new car, paying college tuition, and buying or renovating a home. You can obtain a loan from a bank, credit union, financial company, or private lenders. Most short-term loans come in the form of signing a note or an IOU promising to pay back a loan with interest within 60, 90, or 120 days. A long-term loan might be called a mortgage, which is generally used to purchase property. A mortgage involves a large sum of money and longer repayment terms, usually 15 to 30 years. Loans are generally divided into two types, secured and unsecured. Secured loans are guaranteed by collateral, which is an item of equal or greater value than the amount of the loan. Home mortgages and car loans are examples of secured loans. They are also examples of what we know as closed-end credit, which means a payment of a fixed amount for a predetermined period of time. Unsecured loans do not require collateral and are made based on your credit score and ability to repay. Installment loans are repaid in a fixed monthly payment over a specific period of time. The interest charges are included in the payments. Auto loans and mortgages are examples of these installment loans. Installment loans are also called closed-end loans because of the fixed amount due over a specific period of time. Another example of installment credit might be buying big-ticket furniture or appliances for the home. Credit cards let you borrow money from a card issuer on an ongoing basis. You can choose to repay the amount you borrow in full each month or repay only part, but interest is charged on the outstanding balance. Unpaid balances are carried over to the following month, together with the interest charges. Credit cards are an example of revolving credit. Revolving credit is a type of credit that does not have a fixed number of payments as compared to installment credit. Revolving credit is basically a line of credit that may be used repeatedly up to a specific, with periodic full or partial payments due each month. Charges will be added to the balance if they're not paid in full. Examples of revolving used by consumers include bank credit cards, store credit cards, and gas credit cards. Single payment credit is when you receive services or goods for which you have not paid. However, you are required to pay the bill in full upon receiving it. Your payment to the utility companies are examples of single payment credit. You may have heard these phrases, 90 days, same as cash. This means you are extending credit for 90 days from the date of purchase. You can pay the full amount with no interest charge on or before the 90 days. However, if you pay later than the interest-free period, high interest charges apply to the unpaid balance. Note, interest is calculated from the day of purchase, not the due date. So always read the fine print before signing a line of credit. A payday loan is known as cash advance. It is a small short-term loan that a borrower takes until the next payday. The loan must be paid in full when the borrower receives the next paycheck. These loans include high interest rates if not paid back on time. A title loan is a loan where the borrower provides the car title as collateral for the loan. A title loan is a short-term secured loan available to a borrower if they document that they own the vehicle. Title loans carry high interest rates. Credit has both advantages and disadvantages. By using it wisely, you can accent the advantages. Credit can let you buy needed items now, not carry cash, give you a record of purchase, is easier than writing a check, and consolidates your purchases onto one bill. The disadvantages are higher cost if you rack up interest charges, Some cards have additional fees. Losing track of how much you charged in a month. And of course, impulse buying is a problem with many owners of credit cards. Of course, remember, everything has an opportunity cost. And the opportunity cost of using credit is the reduction of future purchasing power. The money used to repay loans or to pay off credit card bills reduces the amount you can save and spend in the future. So in summary, single payment credit pays in one single payment within a given time period. Examples are from doctors, utilities, paycheck lenders. Installment credit pays in 2 or more regular payments of a set value. Examples are car, mortgage, furniture, and vacation loans. Revolving credit, which has a credit limit and a minimal due regularly. Examples are retail charge cards, credit cards, high-risk credit, such as payday loans and title loans. High-risk credit, such as payday loans and title loans, are short-term loans with a specific due date and a high interest rate.